Well, it was 1 year ago that the fourth largest investment bank in the United States filed for bankruptcy. Lehman Brothers' collapse was a watershed event for this nation's economy. Since it failed, the Dow down more than 1,800 points, 5.8 million jobs have been lost, and the government pledged $700 billion to bail out the banking industry and save the economy. A year later, though, we ask, have we learned any lessons, or will history repeat itself again? Here's ABC's Bianca Ladriga.
People at Lehman bled Lehman green. Lehman green was our color.
We should have seen it coming. In the roaring 20s, the captains of Wall Street promised to turn newfound wealth into unprecedented opulence. Until it all came crashing down October 29, 1929. The Depression led to tamer times. Bankers took fewer risks, rules were enforced, and markets entered decades of stability. Until the 1980s, when the stability gave way to high-risk junk bonds and greed.
Greed, for lack of a better word, is good.
It was good until it collapsed again. New rules were written and stricter regulation was enforced. But now financial houses recruited Ivy League mathematicians who thought they could minimize risks and still reap big rewards, all by bundling risky mortgages and reselling them.
But it seemed that there were people in the industry who knew that the leverage that these institutions were taking on were too large. But there were profits to be made.
That theory imploded last September. And when Lehman Brothers fell, the U.S. financial system followed. When the government stepped in to bail out other ailing banks, the bankers found themselves in the crosshairs of an angry public. Some say Wall Street has learned.
I think there's a touch less arrogance. These firms had survived world wars and presidential assassinations and September 11th, and yet their own inability to manage risk is what ultimately brought them down.
1 year later, Wall Street still stands. Smaller, a bit less flashy, and absent the once almighty Lehman green. But those banks who survived are already back in the green. And that has some wondering just how long the lessons of this crash will last. For Good Morning America, Bianca Ladriga, ABC News, New York.
And joining me now to discuss whether things really have changed at all over the past year on Wall Street, William Cohan, author of House of Cards. Good to see you again.
Thanks
for being with us again. I saw you flinch when you heard someone say less arrogance. you went, oh. What do you think a year later? Have things really changed in the financial industry? Are the bonuses gone, the salaries?
Well, I think what they say is the more things change, the more they say the same. I think that's what we have here on Wall Street again. Wall Street is very good at reformulating itself, reacting to bad situations, and coming out smelling like a rose. And that's what they've done this time. The big difference here, there are two major differences. One, fewer competitors. The loss of Bear Stearns, Lehman, and Merrill Lynch, as it used to be, makes for a big opportunity for everybody who's left. And number two, the firms like Goldman Sachs and Morgan Stanley that are left are now bank holding companies. They have access to Fed money, Fed capital, very cheap financing that they never had before, which is also a great benefit to them. So salaries, bonuses, they're going to be big this year, unfortunately.
The Christmas bonus will be big again, you think?
I think they're going to be plenty big.
In this town, we know all about that. We see it. On the other hand, though, without capital, we have no system, right? We have no economy if we don't have the bankers, and they're always saying that. So have they learned? And it's true. And that is true. Have they learned their lesson? I mean, well, is it fundamentally changed?
Kate, nothing has really fundamentally changed, and this is the real sad thing. I mean, will we ever have a crisis of mortgage-backed securities again? Probably not. Wall Street is very good at fighting the last wars, they say, learning from their past mistakes. But they're also very good at financial innovation. So they're constantly trying to find out, like this life settlements idea that was, packaging up.
That's something we're going to get into next weekend, actually.
Okay, well, that whole idea.
It's a new way of
it's a new way of packaging up things and selling them to investors and making money. Wall Street is very good at figuring out how to make money. And that's what's happening now already again.
What's your biggest worry right now? What's your biggest concern?
Well, my biggest concern is that, as we were talking about, nothing has really changed in the way people are rewarded on Wall Street, what their incentives are to do. And to me, human beings are pretty simple. They do what they're rewarded to do. On Wall Street, they're rewarded to make more money, do more, have more innovation, make more things, sell more things. And until that changes, we're just probably in the process of reinflating another bubble that we don't even know what the components of it are at the
moment. And beyond Wall Street, you say you're worried about commercial real estate. Explain that quick.
Very much so. Yes, there's $3.5 trillion of commercial real estate mortgages out there that are probably that were put on the books in 2005, 2006, that are supporting assets that are probably underwater, i.e. they're not worth. So the whole recurrence of what happened in the home housing market
could happen in office buildings?
In the office buildings, exactly right, and it's on its way.
You got any good news for us?
Well, it's a nice day here in New York.
There we go. Thanks for being with us again,
My
though.
pleasure.
In all seriousness, we appreciate it. And